Good afternoon and welcome everyone to our property casualty market outlook for Q3. It's 1:30 here in the East. We're going to wait another 30 seconds or so as the ticker of folks dialing in continues to ramp up. So give us just a little bit more so everyone can participate and hear the entire webinar. Thank you. Okay, so that's the magic number I was waiting for. It's still continuing to tick up. So why don't we get underway here? Let's start off with just a quick housekeeping item here. To ask a question, please type it into the questions box and click send. Questions will be answered at the end of the presentation. And we will do our best to get to as many of those as possible. So please do submit your questions as per the instructions there. At this point, I would like to introduce you to our panel of experts. First is Carl Olson, Vice President, Professional and Management Liability Practice Leader, Burns & Wilcox Brokerage. And Carl is physically located in San Francisco. Hello, Carl. Number two is Chris Siegel. Chris S. Siegel, we need to find out what that S stands for, Associate Vice President, Managing Director of Orlando, Florida. Chris, welcome. Look forward to our conversation today. And we have Brandon McCarty. Brandon is Northeast Practice Group Leader for Personal Lines Insurance Group here within the Burns & Wilcox organization. My name is Paul Smith. I'm a Senior Vice President with the H.W. Kaufman Group and the moderator for today's discussion. So let's get underway with our conversation for this afternoon. Welcome to our audience. We look forward to having your time and attention for the next 45 minutes or so. So despite our panel of experts representing three distinct areas, Carl being professional liability, Chris being commercial, and Brandon being personal insurance, you'll see a common theme throughout today's discussion within three overarching topics, and they are inflation, both social inflation and financial inflation. Number two, capacity. And number three, technology. To set the stage regarding the state of the market, let's get some facts out there and start with some facts from some other organizations that we rely on, and to just kind of set the table for today's topics. So according to AM Best, in March of 2023, just a few months ago, and this is a quote, the U.S. property casualty industry recorded a $26.5 billion net underwriting loss in 2022, a slide of $21.5 billion from 2021, end quote. They went on to say that the combined ratio deteriorated in 2022 to 102.7 from 99.7 the year prior. Interestingly, the deterioration came despite, ready for this, 8.4% growth in net earned premiums and a 21.4% decline in policyholder dividends. So I asked myself why when I read that. Premiums are going up, policyholder dividends are going down, but loss ratios are going up and no one's making money. As a matter of fact, they're losing money. So, well, the answer to it is that incurred losses increased by 13.9%. So despite all of those changes that have been going on in the marketplace for the last few years, we saw a 13.9% increase across the property casualty sector as measured by AM Best, a 13.9% increase in losses and allocated expenses associated with it. So if that's not enough, let's look and see what AM Best just came out with only within the last 30 days. They came out with their Q1 2023 report. So in the March report that was once again just issued within the last month or so, the U.S. property casualty insurance industry recorded an $8.2 billion underwriting loss compared to a net gain of $3.4 billion in the same period last year. Things haven't changed much so far in 2023 is what that says to me. The combined ratio deteriorated yet again over 6% in the quarter as compared to the same period last year, mainly attributed to catastrophic losses being 3 points higher than the same period last year. Such statistics, I think everyone would agree, are just going to kind of continue this bumpy ride in the marketplace. We've seen a lot of changes over the last couple of years, and we just continue to, based on these statistics from third-party organizations, once again, AM Best in this instance here, things aren't changing. They didn't change in 22. They didn't change in the beginning of 23 with what we've measured so far through the end of Q1. So now I would like to turn to our panel of subject matter experts for their insights and reactions to some of those things there. Chris, let me start with you. With regards to the commercial space, what are some of the primary contributing reasons or factors that these deplorable statistics are continuing on?
Well, thank you, Paul, and it's a pleasure being here with you today. I appreciate this opportunity, but those statistics, unfortunately, for us on the front line are all too real and all too true. And what we're seeing across the genres within the commercial space itself, whether it be property or it be liability, are contributing factors to it. One, on the property space side is just the prevalence of cat events. Whether it be within the largest CNS states themselves, mudslides and fires in California to hurricanes in Florida. You've got weather patterns that are seemingly erratic all over the place, flooding in Delaware that just occurred earlier this week, started last week. There really seems to be no break within the property market itself. And all of that, of course, then gets passed on into the reinsurance marketplace as well, which has definitely hardened both of those, the primary and the reinsurance spaces. In the liability space, we're definitely faced with a prevalence of and a high frequency of claims through litigation. We have become very litigious within the United States of America. Some states, mine in particular, Florida, actually leads the country in lawsuits that have been filed. And in some instances, it's easier and cheaper to just pay those, which to a degree kind of encourages similar behavior to continue. But all of that just contributes and adds into additional losses being paid at higher amounts with more frequency, which never bodes well for the actuarial game that is insurance.
Yeah, hey, absolutely. And, I think I've read some stats recently that there's more claims being settled these days. No one wants to get in front of a jury. So thanks for those insights. Brandon, over to you now. Are the facts that Chris mentioned consistent with what you're seeing in the personal line space?
Yeah, absolutely. One thing Chris touched on was the fact that what I've seen recently is that the cat zones are expanding larger than they ever have before. Not only up and down the coast, California into the wildfires of Colorado and such. Actually just read a recent article that Tornado Alley that we've known through the plains much of our lives is actually expanding not only west and east, but also north. Just last night, Chicago was hit with tornadoes that hopefully everybody's safe and everybody's okay, but it's just things that you aren't used to 5 or 10 years ago that are completely changing the landscape on things.
Yeah, hey, no question about that. I think we all read that this morning. They were hunkering down in Chicago in the tunnels underneath the stadiums and the airports and things like that. So our thoughts to our friends out there in Chicago. Carl, off to you now. So the AM Best stats and comments that the other panelists have discussed are primarily first party, for the most part. But from your standpoint, exposures and losses are changing all the time in the liability space too, specifically in the professional space. So tell us about inflation specifically and how inflation is impacting what you're seeing in the professional liability area.
Sure, thank you, Paul. There are really two different stories to tell. For professional liability, management liability, we have a good number of lines of business coverages where the pace of rate increases have slowed and even reversed. Things like cyber, where it was 20-30% rate increases are now flat to 10%, and in most cases we can even get rate decreases. Flat renewals pre-agreed on cyber just don't really fly. There's a lot of competition out there. In the D&O world, we're seeing anywhere from 10 to 40% rate decreases. And The other side of that story is that we read about reinsurance, and it's becoming more difficult to get. It certainly has become more expensive, and that's affecting professional liability. It's going to take a little bit longer to trickle down to the street level, I think. But you know, one of the factors there is the social inflation, like you mentioned. And I think the best way to describe that is just sort of the lottery effect, that people are used to seeing amounts that 10, 15 years ago were just almost unheard of. You know, some of that's driven by an anti-corporate mentality. Some of it's driven by litigation funding, and a lot of it's driven by if something goes to jury, outcomes are much less predictable than what they used to be. You know, there's nuclear verdicts that you hear about. You know, that there's products, fines, you know, in the hundreds of millions of dollars against companies. Bank of America just this week is going to pay a $225 million fine about over fees that they were charging their customers. All of that is driving up the cost of claims, obviously, and having a big impact.
Yeah, no question. You know, Carl, maybe if you could just talk to us a little bit more about the distinction between, say, management liability lines like, you know, D&O versus med mal and some other specific lines, because I think there's a real divergence between what's going on in the general marketplace, if you will, on say D&O versus you know, some more challenging E&O lines.
Sure, certainly for management liability, D&O, public or private, we are seeing those rate decreases. We're seeing the standard markets jumping back in. We're also seeing new programs that are rolling out new products. Excess D&O, where it was not that long ago, 95% rate online, going up the tower, are now 70% or less. So a lot of that rate gain to benefit the insured is happening on the excess layers. But primary, there's a lot more competition out there. Med mal, the healthcare industry is a little bit different, where we're not necessarily seeing the admitted product for med mal. You know, they're not getting the rate increases agreed as they have been requesting. But it's the social inflation factor for med mal is certainly a big thing. One of the benefits now of just 2023 is that we're mostly past pandemic, and the healthcare industry is somewhat recovering. But then they're dealing with factors of increased cost of providing care. I read recently that that's expected to go up 8% next year. Reimbursements are being reduced both by governmental programs and health plans. And just the factors going into the insurance world of nurses retiring, physicians leaving the industry. All of that is certainly impacting how medical care is being provided, and then that certainly affects how underwriting occurs and what they're looking at.
Yeah, so tale of two worlds, right? Some of the med mal stuff is going in one direction while the management liability is going in another. Thank you for your comments, Carl. Chris and Brandon, we used the term social inflation, I think 2 or 3 times now. It would seem to me that that has to be impacting your space as well. Chris, maybe if you can start off and talk a little bit about how that's impacting, you know, say excess policies and things like that. And then Brandon, if you can pick it up, what's happening in personal umbrella space. So Chris, if you could just jump in first on that one.
Absolutely. And the significant impact that we're seeing, and it really is, and excess is a great example of it, where as has been alluded, the nuclear verdicts, the higher claim settlements and all of that is more frequently we're finding kind of piercing the threshold of the underlying primaries, and it's headed into the excess space. Which is causing a significant drain on the ability for excess carriers to be as robust as they once were, predominantly through the limits that they were previously available to offer. The ability to place 10 million in excess with one carrier, 5 to 8 years ago was a commonplace. It was relatively normal. You had a lot of options that were available to you. Now we've had a lot of excess carriers that have exited a significant number of classes, those especially that are poor performing. And even in the ones that they have probably performed even better on, they have become more risk averse, and they're just not as willing to put themselves out there at the limits that they previously did. So we're having to find ourselves go into more of a layering process and a layering scheme, even on the liability side. We traditionally kind of thought of that as more of a brokerage property play, and we're having to now see ourselves do it more on the liability standpoint. Florida is a prime example. It was a significant habitational exposure within the state. With the condominium collapse that occurred just a handful of years ago, programs that were offering 15 million in limits and doing so easily and almost wantonly withdrew from the market entirely. And now to find excess limits on habitational, it takes a lot of creativity and a lot of work to even really kind of get 5 to 10 million in place. So it definitely is a significant dichotomy from what it used to be just a handful of years ago.
Yeah, and hey, you bring up a great example. That has nothing to do with social inflation or financial inflation, right? That condominium collapse came out of nowhere, and there's so much of that exposure. So I can certainly see the hesitation from capital providers in that regard. I don't think you're alone, though, in Florida when it comes to HAB. I think that's a nationwide issue, perhaps a little bit more emphasized in Florida. Brandon, in personal umbrella space, you've seen some similarities there?
Yeah, absolutely. Chris mentioned earlier in this conversation that he mentioned how easy it was to get a $5 or $10 million umbrella policy a couple years back. As recent as 2 or 3, to be honest with you. But what we've seen specifically in 2023 and going forward is the need for creativity when layering these different umbrellas to get to a certain point liability-wise. So definitely see that day in, day out. And then the other thing that I don't think we realize as much is that there's more millionaires than ever before. And I don't know if it's the industry itself, we're not teaching them correctly, or having those conversations. But because of that, they don't know what their worth is, and they're not covering themselves correctly. So I think in the industry, we need to do a little better on that aspect.
So I'm grinning. I literally received at home within the last few days a flyer from a local agent, and it said something along the lines of, you don't need to be a millionaire to be sued like one. And they were trying to sell personal umbrella business. So it was interesting when you said millionaire, it certainly, it kind of piqued me there. So, well, thanks for those comments. Really appreciate it. So Chris, we talked a little bit, I'm going to go back to you now. We talked a little bit about HAB, difficulties in Florida. I said that it's kind of difficult throughout the balance of the country there. Tell us about other classes of business that have become increasingly harder or more difficult, and what the common characteristics are of those classes.
Some of the other classes, definitely the hospitality industry has taken a very hard hit over the past couple of years. So traditionally, where we would see hotels and motels in restaurants, especially those with a significant liquor exposure, as being good E&S business, that has shifted exponentially away from that belief and away from that thought. The market has shrunk considerably on that. And again, the exposures are similar in the sense that you're talking about high volume, high traffic areas. You're also talking about multifaceted exposures. And there are just certain things that ideally carriers can't carve out, because then there would be no coverage for anything if they had the ability to just simply provide a certificate of insurance. So, if we look at the hospitality space, specifically hotel motels, you've seen a change in the endorsements themselves. There's now human trafficking exclusions, assault and battery, and even sexual assault exclusions are almost commonplace, or were commonplace a couple of years ago. And even with those types of exclusions or carve-outs, that still remained a non-profitable space from an insurance company standpoint, because you still had the significant slip and fall exposure. People still viewed that to a degree as kind of a cash cow. You still had the pest control issues and the bed bugs. Restaurants follow in the same space. But also within the legal environment itself, you had the ability in a number of states have followed suit, and you kind of think sort of towards Louisiana, where they're allowing some of these upstream claims. So not only can you sue the restaurant for over serving and being brought in, even though that individual may have started or ended their night there, it has the ability to also impact up to the distributor and even potentially all the way up into the manufacturer, just in an effort to try and lump everybody in. And we go all the way back to what we discussed at the beginning of this, that in those instances, they're reticent to go to court to try and prove that they should not be a part of this lawsuit. And they quickly come up with a number that makes sense, and they just cut a check and offer a settlement at that point in time. So the HAB space is challenging. The hospitality space, restaurants, hotels, motels, even lessor risks have gotten challenging. There was a lot of concern with the strip mall type approaches, with the cannabis stores that have become prevalent, it seems, in almost every single one. To the point where carriers are now taking a look at the LRO type business. And what's concerning there is within the lessor risk policy, or in that transaction itself, the tenant is intended to carry insurance that names our insured as the lessor of that property as an additional insured to their policy. So you would think that would be a good risk management transfer mechanism built within that transaction. And the lawyers are finding a way to pierce that relationship and access both policies. So it's really become a difficult space for a lot of very traditional E&S classes of business.
Wow, no question. You hit on a lot of places there, right? HAB, hospitality, LRO. LRO was so to speak, layup business back in the day, right? Not anymore. And liquor. Finer emphasis on liquor. Certainly liquor is becoming a big issue. We've seen some carriers exit that space. Certainly carve back their appetite. Very, very difficult class of business these days. But we're certainly well equipped and ready to handle that for anyone that needs it. Brandon, tell us about within the personal line space. Tell us about, I keep hearing capacity and aggregate and how important that is and how vital that is. And that's really, it's what it's all about these days. So talk to the audience, talk to us about how we're handling that here within Burns & Wilcox.
Yeah, absolutely. So I think what has happened over the last 6 to 12, maybe even 18 months is that we are getting a tightening capacity and things are harder to place. And what we've done here at Burns is actually come up with creative ideas to not so much skirt them, but still provide a good layer of coverages while keeping the price point down for the buyer itself. So here at Burns, we have wildfire exclusion out west for California, Colorado, those type of things. Florida, we've come up with Florida and other states in the Southeast, we've come up with a wind buyback program. As you know, years ago, the wind, your wind deductible was 1 or 2%, then it was 5, and then it was 10 rather quickly. And so those were just going so high that we've come up with a wind buyback program, which helps a lot. And having that relationship with carriers and being able to speak them through ideas that where we want to head, and being as close as we are to a lot of our carriers allows us to be as creative we can be and gain extra aggregate where we see fit. So.
Yeah, and I think, just our longevity in this space and the ability to perform with good results over decades, as I like to say, positions us quite well from an aggregate and capacity standpoint. We have a RAP program out west as well, right? Sits around the FAIR Plan out in California and provides, coverage up to, traditional HO standards, if you will, to sit around that capacity provided by the state. So, Carl, over to you now. Speaking of capacity, can you talk to us a little bit? I'm going to kind of change direction a little bit on capacity here. I want to talk to you about new entrants into the marketplace, what seems to be almost a daily emergence of a new MGA that's providing some type of capacity with a carrier behind it or a reinsurer behind it somehow. Tell us about what you're seeing there in the new entrants in the MGA space within professional.
Certainly, for professional, it's certainly our job to know what's happening with product and new product introductions. I don't think we have time to get into all of it here, but there are a few things, common themes I'll just touch upon. One is that there are new MGAs, new products being rolled out. usually led by teams of underwriters that we know and trust. Usually when you see something new, it's sometimes hard to recommend that to our retail broker clients, who then have to sell that to the boards, right, or the risk managers or the CFOs that they're working with. But I think that the backing of a lot of these newer programs for D&O, for A&E, they're pretty strong. We feel pretty good about those. And obviously we have a thorough vetting of all of these programs, Paul, that you know quite well. In terms of one of the things that we keep seeing now for professional liability is sort of the bifurcation of underwriting teams between retail and wholesale. And we have more underwriting teams that are dedicated within the same carrier to either side. Sometimes there's a differentiation of products between them. Sometimes it's the same product, same rate, same endorsements. And so, when it comes to something like that, it's our process in terms of how we broker business, where we try to differentiate ourselves, both from direct retail access or other wholesale brokers as our competition. In terms of MGAs, I do know that I think everybody's best guess, or anybody's best guess for MGAs, is about a $65 to $70 billion market, right? And so MGAs are the delegated authority for underwriting rates, forms. MGUs would be the delegated authority of an MGA plus claims handling. When I say that it's about a 65 and $67 billion, that's about a 14% growth rate in 2022. And we all know that MGAs really address that specialty product, the niche product, that standalone sexual molestation that sometimes is now excluded elsewhere. We're also seeing too where MGAs are stepping in and they're taking blocks of business off of the hands of underwriting teams from standard carriers or just some of the national carriers. They'll sort of create their underwriting box up to a certain revenue threshold, employee counts, or certain industry classes. And, they step in and fill a need.
Yeah, so you bring up some great points there. I think the first one is these are people that right? They may have a different name on their business card, but they're individuals that presumably you've worked with at other shops, at other organizations and things like that. So, it's folks that you have a relationship with, right? And I think we all understand how important that is. And then, of course, the vetting process. You took a little shot at me there, Carl, so that's okay. But that's my job, is to make sure that we have quality organizations that we're working with, and they're going to be around the pay to claims ultimately. And I can assure our audience that that we take that very, very serious, and we have a very robust process in place to make sure that the folks that we're presenting to you have passed a very, very vigorous test with us internally through legal, compliance, etc. So that's a good thing. It's good housekeeping. Chris, I'm going to go back to you. Change gears a little bit here. Take the audience through the outlook, balance of the year, third quarter, balance of 2023, maybe a peek into 2024. Just generally speaking, within your area of expertise in the commercial, kind of contract buying business as well as small brokerage business, what are you saying?
I wish I could say that I thought that there was good news on the horizon, but I don't necessarily believe that there is. I think what we can hope for as best for the remainder of this year is that we don't have any more reduction in capacities. We don't have any more mass exits from classes of business, that we almost to a degree see more of a flattening, and that could be in appetite and also in rate. There have been a number of states that have enacted legislative changes. It really is kind of a wait and see game what the impact is going to be ultimately on removal of assignment of benefits, tort reform, those states that have made concerted efforts into actual true tort reform, what those impacts may be on the carriers going forward. So we're hopeful in 2023 that we see all of those things occur and happen. The great unknown, however, is if the wind blows in the state of Florida or something else catches on fire, or we've got another mass flood in a significant portion of the United States of America, all bets are off the table. So it really is kind of a wait and see. I think everybody's holding their breath, especially in the reinsurance markets, and also in London itself. Domestics, I think, are taking a similar approach as well. Everybody is definitely taking rate in an effort to drive profitability and drive more of that profitability that you shared those wonderful facts and figures with at the beginning of this call. That just completely illustrates how that lack of profitability has had this significant impact on the market. So we've addressed insurance to value issues in a number of states. And of course, the rate that takes that attraction into place. One of the things that we normally see when you get a hardening in one side of the market or the other, and in this case, we have a significant hardening in the property market. Typically, you might see a reduction in the liability side in an effort to try and offset some of the lost premium dollars from lost business within the property market. And for a significant portion of this year into this quarter, we haven't seen that. We've seen a little bit of a flattening in the liability rates in some classes, and liability, of course, has a little bit better in that there are so many varying classes that carriers have the ability to pick and choose where they want to be aggressive and what is a good performing class of business for them within their business model. But we're starting to see a little bit of a flattening, maybe a little bit of a softening there as people are getting aggressive to try and offset some of their losses on the property side. But it's just not where it needs to be as far as what everybody is hoping to see, and especially as it relates to our retail client side and then ultimately the insured side, where they would love to be able to deliver some good news at some point in time, which would be a cheaper premium. And that's not happening. It's probably not going to happen for the remainder of this year. And I think it's going to continue to be a wait and see approach into 2024 as well.
Yeah, couldn't agree more. Wait and see. I started the conversation with the bleary forecast coming from AM Best. We haven't seen the full effect of some of those changes, particularly down in Florida with the assignment of benefits. We still haven't seen the effect of 6/1 and 7/1 treaty renewals for carriers. And perhaps most importantly, we haven't really seen the 2023 Atlantic hurricane season yet. So those things will all play a very, very important role into how the balance of the year turns out. But we're not off to a good start. I can tell you here in the Northeast, we had some horrific storms on Sunday. You know, no one's really talking about it. I'm sure there's going to be a lot of losses coming out of places like Pennsylvania, New York, New Jersey, up in Vermont on the news this morning. Significant flooding from flash floods. So let's wait and see. Brandon or Carl, do you guys want to just chat quickly a little bit about what you see in your marketplace for the balance of 23 and into 24? And then I'm going to pivot into a new topic. Brandon?
I'll be short and sweet there, Carl. So what I've learned and seen this year and going forward is just how important our relationships. I mentioned it earlier. The fact that here at Burns, we're actually coming out with 2 new programs kind of shows what type of relationships we've had with these carriers and how important it is not only to the carriers themselves, but to the retailers. So I think that's a main focal point for us here for the remainder of the year and the foreseeable future.
Thank you. Carl?
Brendan, to your point too, I saw a segment on CNBC yesterday about personal lines and the availability of coverage. It's going to be a big deal. It is a big deal. Specific to professional liability though, I do see that there's what we've had in the first 6 months is a lot of what we're going to see in the second 6 months. Certain classes hardening of rates, certain classes softening of rates. A lot of it affected by just the changes in the economy. Professional liability is all negligence based, and it's all current rating exposure basis. And so as companies rebound post-pandemic, we'll see revenues go up or solidify balance sheets probably in a better place. So that just means that more underwriters are going to be more aggressive at getting after those healthy risks. In terms of one aspect that is changing a little bit outside of the product is the process and the introduction of more technologies. I think anything generative AI at this point is also new. That you know, as people are rolling out marketing messages, I think they are just that. They're marketing messages. AI is so entirely new that a healthy introduction of that into our industry is we're at the very precipice of it, but I don't think anybody's there yet. But certainly something that's to be watched, to be addressed, and very likely to be introduced into what we all do. There's separate to that, but along those lines too, we're seeing distribution changes and how there are platforms for submissions. There are carrier portals for accepting submissions. All of that's meant to be more efficient, but I think we would all say that we're very much still in a people business. So there are certainly portal specific risks where that's very appropriate. But there's still a lot of business out there where it takes some people communicating about it.
Yeah, and I think that there always will be. Certainly technology's taken on a new role, you know, within distribution, within our carrier partners. I just saw a demonstration here internally of an item we have in user acceptance training at this point. That was it just blew me away how cool it was. So there's a lot of that going on, but the relationship piece of it will still be there, right? We're going to have deals that certainly need to be on the, you know, that are going to have, you know, significant broking, so to speak, to use an old school term. Brandon or Chris, do you guys have any additional comments on technology that you wanted to share before I kind of move on? No? I don't see any hands being raised.
You go ahead, John Paul.
So we talked a little bit about, you know, relationships, right? So I wanted to, you know, maybe Chris, maybe you can chat about this one a little bit. Talk to us about the importance and the contributing factors to growing relationships with not only our carrier partners, but with our retail partners as well, and why that's so important, and particularly in this marketplace.
I think it's definitely vitally more important in this marketplace than it probably has been in a long time. And part of that is you're definitely seeing, with the shift in the marketplace and the availability of product, we look at property in the form of aggregate. Growing those relationships and more importantly, focusing on those relationships for positive growth allows for more dedication of product and services to foster those ideals, to foster those relationships themselves. You know, we focus on developing a relationship on the carrier side so that when we get a submission or we have to make a referral, or you know, we have to speak to an underwriter and kind of get their opinions or their thoughts or ideas on what a risk is and how to go about properly underwriting it for pricing consideration. You know, we want to make sure that because of the nature of our relationship there, that they're picking up the phone when we call. That when we send a submission in, it's a good quality submission, it's a qualified submission. There's two differences there, quality and qualified. And that the underwriters, when they know that and they see our name, not only Burns and Wilcox, but it could be any of us as producers as well, that there is that level of trust that they're sending me business that they know I have a chance of placing. It's not just being shotgunned out. And that is the nature of relationship development. When it comes to our retail client partners, that relationship, insurance is a very important financial transaction, and there has to be that level of trust. And it's one thing to like somebody and want to do business with somebody because you like them. It's another thing that through the process of getting to know that individual and potentially liking them, you also come to the realization that you can trust them in this transaction, in this process, that when we present a quote to them, we're highlighting instances or forms that may be of concern to them and to their insured. You want to draw their attention to those types of things, that we have their business at heart, that we're not just simply a transaction point, and treating their relationship with their insureds as that. While insurance itself is and has become, as Carl spoke so eloquently too, with the advent of technology, it's seemingly becoming more and more and more transactional. The relationship can't be treated as transactional in nature. It's not going to grow in that type of a treatment process, and it's not going to ultimately provide what everybody is looking for in this current marketplace, which is a value added proposition. What are we bringing to the table? What are our carrier partners bringing to the table? And what are our retail clients bringing to the table? Everybody is really kind of looking towards wanting to put forward their best services, their speediest services, and be most expedient to those relationships that make the most sense.
Yeah, absolutely. So you hit on a whole lot of different factors there. Quality submissions certainly make a difference. Relationships make a difference because, you can have a conversation with a carrier partner and they know that they are not going to get a lousy submission from you, that it's going to be a proper submission. And, let's face it, a lousy submission these days probably won't even get looked at. So it's just the price of admission. Quality counts these days for sure. Hey, before we kind of get going with some kind of final wrap-up questions here, there is one from the audience that I'd like to address, and it really kind of deals more with Carl and Chris. You both kind of touched on this here. It's rather small, folks, so sorry if I'm squinting. Are you noticing that more exposures are leaving the BOP or package dynamic, and lines of business are being broken up between these new carriers who are specializing in only one line of business? So I guess the question is, are we breaking up package policies and BOP policies and starting to individually place them with specialized markets? So Chris, you're nodding, so why don't you take that first?
We are absolutely seeing greater historically what was previously written on a BOP. A lot of the BOP markets themselves are facing the same things that we're seeing in the E&S market. The admitted markets themselves aren't excluded from anything that's been shared here. And they are exiting specific classes of business or reducing their coverage in such a way as they're not able to provide what that insured needs themselves. So we are seeing a lot of commodities, a lot of classes of business exit the BOP market, enter into the E&S. Obviously, we'll do our best to package it. It's not going to be a BOP package. It is going to be, more strictly limited to the property and the liability classes, with some bells and whistles here and there. But even then, dependent upon the individual risk characteristics, we are still seeing a lot of individual liability and property placements because that just really has become the nature of the market itself. Whereas some carriers definitely want us to package, they want that liability premium in addition to the property, and in some instances won't even allow you to place property without that liability portion coming along with it. There are still a number of markets out there, and especially as we're seeing once you remove the cat exposure, those markets are more willing to offer standalone X-Wind or those types of policies, stripped down coverages. And they're willing to put that foot forward. But yeah, the BOP market is definitely facing a lot of the same things that we're seeing everywhere else as well.
Yeah, so it would seem to me that, maybe in the past, if there were some elements of professional liability included in there, some elements of environmental or some elements of other kind of specialized lines of business, just not happening in this marketplace is really what it comes down to. Hey, we're down to 2 minutes here. I'd like to give each of you the opportunity to share with our audience today pearls of wisdom, ideas, thoughts. How can they best distinguish themselves in this marketplace and help themselves to help us to get the best deal for them in the marketplace? So Brandon, why don't we start with you, and then we'll give Chris a little breather. We'll go to Carl after that, and we'll end with Chris. So Brandon?
Yeah, thanks, Paul. I think we've touched on it a couple different times. For the remaining 6 months or so and into the next year, I think it's going to be a race to get out and see our clients, our retailers. I think the relationship growth and asking for specific risks that we're going to fit our carriers' needs is going to be extremely important in growing our relationships, both internally or externally to retailers and towards the carriers. I think it's going to be hard. I think it's going to be rough, but at the end of the day, very happy where Burns and Wilcox is headed with the platforms that we're coming up with and the products we have.
Carl?
Absolutely. I think few things that I'd touch upon. Specialization, which then leads to communication, and that's where we can engage, other offices, other specialties. I stay in my lane with professional liability, but there are others here on the call, where there are other capabilities. But those communications are also important with our retail brokers, setting expectations, developing strategies of replacements, and then ultimately it's that flight to quality for submissions. Getting our underwriters time with complete, thorough information and also a good definition of the opportunity.
Terrific. Chris?
Carl, I think you hit the nail right on the head there. I'd sum it up in one word: collaboration. I think there definitely needs to be collaboration between all facets of the insurance transaction itself. But if you're looking at organizations that you may want to partner with, I think you need to take a close look at how collaborative that organization is internally amongst themselves. And Carl just did a great job saying that, we have our specializations, but typically when we come out to market, you will see us bring cross disciplines with us. It's not just one person coming into an office. We're going to come talk to you about personal lines, professional, environmental. We're going to talk to you about anything and everything, and we're going to have the resources behind us to solve all of those issues for you.
Terrific. Thank you. Really appreciate it. Thank you to our expert panelists this afternoon. No question, you guys have been really busy and your teams are busy. So thank you so much for taking time out of your busy agenda and your busy schedule to speak with our clients and so forth this afternoon. Thank you to our audience. We really appreciate your time as well. We appreciate the confidence that you've placed in us and instilled in us. So, please continue to work with your local Burns offices. Be on the lookout. We will have our written quarterly report out to you, probably by the end of next week, I would say. And that will include a whole lot of commentary from the panelists that you just saw, plus many of our other subject matter experts, whether they be here domestically, Canada, or in some instances, even abroad. So thank you for your time this afternoon, folks. Really appreciate it. Enjoy the rest of your summer, and we will see you in early October for our next webinar. Thank you so much. Take care now.